And let's see if I can share my screen. Samirbai, please enable me to share my slides. Okay, there we go. And I hope you guys can see my slides now.
Yes.
Awesome. Okay, so today we're going to be speaking about, a guide for raising funds and the Singapore startup ecosystem. So tell you guys a little bit about myself. I've spent over a decade in the startup ecosystem of Singapore. It started with about 8 years in the public sector of Singapore. So can I request those of you who have your mic on to please mute, because I'm hearing like some sounds in the background. So thank you. So it started with about 8 years in the public sector of Singapore. There's an organization called the SME Center, which is part of Enterprise Singapore. And what I did over there is, it's basically the advisory arm for Enterprise Singapore, where I did a lot of advisory work for SMEs and startups. And it was basically around things like grants, tax incentives, fundraising, strategy, structure. There was a lot of interaction with incubators, accelerators, venture capital funds. And the mandate typically for the SME Center was businesses that are below 100 million in revenue, like 100 million Singapore dollars and below. So this included, family businesses, recruiters, IT companies, restaurants, manufacturers. But the segment of it that I enjoyed the most was the startup ecosystem. And I took the opportunity at that time to learn as much as I could about the startup space. And I formed partnerships with incubators, VCs, accelerators, co-working spaces, and my team and I would go in and give talks in these places to the founders, and then we would try to help them from the government's perspective to see how best we could help enable these businesses. Towards the end of that, I decided that, okay, I want to go back to school. So I went back to school and I did my MBA, executive MBA, while I was working. And it's exhausting, but it was fun also. I would highly recommend working and studying at the same time, because there's a lot of like peer learning that happens, which I thought was really cool. There's a lot to learn. After that, I joined ING Bank. It's a Netherlands bank, which had an innovation lab in Singapore where I worked as a venture builder. And my role over there was to examine problem statements from the different departments in the bank. And then we would study the feasibility, viability of those problem statements to see how we could build ventures to address those problems, either ventures that the bank could use or that we could sell perhaps to our clients. After that, I joined KPMG for a short stint where I was helping them build an accelerator for Series A startups. Series A startups in the ESG space. So that's a pretty upcoming sector. I think ESG related startups are going to be really, really in demand over the next 5 to 10 years, I would say. I'm an active angel investor. I've advised over 3,000 startups over the last decade. I'm an advisor with 3 accelerators, founded 1 angel investor group, and I'm a advisory board in multiple startups. And I hope that my journey of learning will continue, because I think that there's so much to learn in the startup space. Every year the landscape changes, and it's been a lot of fun learning about this particular segment. So some of the startups that I've been associated with over the years are, I was lucky that last year I made an investment into PrioShop. A few days ago, I signed a deal with Turtle Ventures to join them as part of their advisory board. Pattern is a startup in Pakistan that I invested in also last year. You guys might know Stuffbase. Lums Consultancy Group is the consulting arm of the Lahore University Management of Science. And Homefectionary is a startup that you guys might know. I'm on their advisory board as well. And Seedify, which is a Singapore startup that is using blockchain technology to bring together LPs, VCs, angel investors, and startups onto one platform to help make startup funding more.
Hello, Mustafa bhai. Probably your screen is stuck because some audience is telling that slide is not changing.
Okay. How about
Sorry
now?
for the interruption.
No worries. Can you guys check the slide now?
No changes, it's still stuck.
Perhaps I may stop sharing and then.
Then again, you share the same slider. Yeah, it's work. Now it's work.
Can you guys see it like big or is it small?
It's okay now, but yeah, it's okay.
Just an advice, I think you need to share your entire screen. Just to put the entire screen mode, that may help.
Sorry, I'm gonna try again. Apologies, guys. So I hope this works now. Gosh. Just bear with me for one moment. I'm just gonna go with it like this, huh?
Yeah, we see that.
Okay, I think we can carry on.
Okay, cool. So some of the startups that I've been associated with, been very lucky that these are, some great organizations. Ventures, Pattern, StuffBiz, Consultancy Group, Homefectionary, and Seedify. I had the opportunity to learn an incredible amount from these guys, especially Asikul Bhai from PrioShop. It's really been an interesting experience together with him. And he's in Singapore every 2 or 3 months. So whenever he's here, I take the opportunity to learn from him. So, okay, enough about me. I'm gonna jump right into the knowledge sharing now. So the segments that I'm gonna cover are startups, angel investors, venture capital firms, corporate venture capital, private equity, syndicates, multi-purpose vehicles, multipliers. And then after that, I'm going to go into some advice about fundraising as well. So yeah, so let's kick off into the content. Okay, so startups. It's one of those things that we all know what startups are. But if somebody were to ask you, what's the definition of a startup, right? Like, let's say your uncle or aunt or somebody were to ask you, what do you do? I work in the startup space, but what is a startup? Typically, a startup is a micro business. So there are startups that are very, very large, and I would debate that are they still startups today or no? Perhaps they're not, right? When they become big. But startups are typically a micro business. They are a young company. They are tech-enabled. So generally, most startups are tech-enabled. They're innovative, meaning they're doing something in a different way and they're disruptive. So they're trying to change the way something is being done before into a brand new way. So perhaps going against the current, going against the way things are done currently to try and make it better. And lastly, startups are generally poised for high growth. When you look at SMEs versus startups, I realized that SMEs and micro SMEs are typically like to earn a living out of it. But when it comes to startup founders, I realized that they're typically there's something much bigger that they aspire for. They aspire for like some sort of exponential growth or exponential payoff, which is very different from trying to meet their daily needs. So this is what I mean when I say poised for high growth. So similarly, when it comes to angel investors, right? So an angel investor is someone early stage capital, the highest risk when it comes to fundraising when it comes to investing in startups. And I consider myself somebody who has a high risk appetite. Generally, an angel investor has a high risk, high return appetite, you would say, and they're typically not with the few percentage that comes from dividend stocks or the few percentage of interest that comes from putting your money in the bank. They're willing to risk a medium amount of money to get a higher return. So they typically invest in risky, unproven ventures, early stage or even mid-stage ventures. For angel investors, the return is binary. It's a binary outcome, meaning so zero being the worst case scenario where you'll typically lose all of it. It's the opposite, whereas it's one. That means you could have your return, in many multiples. And I've seen many cases, and I've heard many stories of like investors, losing 100% of their money. And I've seen cases also where investors get 25, 30, 40x also of their return.
Mustafa bhai, sorry for the interruption. Sound is probably we have some sound issues because audience they're saying that in the chat box.
Okay. Hold on a second. Okay, can you guys hear me better now?
Yeah, it's okay now.
It's okay now? So
Yeah.
fan running in the background, so maybe that was.
Yes, yes.
Okay. So typically an angel investor will invest in, let's say they'll buy equity of the startup, loan money to the startup, or they'll have a safe note or some instrument like that. Increasingly over the last 5 years, but maybe less than 10 years, in Singapore, we've been seeing that
English like that.
become the majority of the way that startups are fundraising lately. Startups from Bangladesh, Pakistan, India, I'm also seeing a lot of safe notes these days. So safe notes are probably as the name implies, the safest and the best way to document fundraising for your startup. Looking for like a safe note template, there's one on the Founders Institute website, which you can download for free. Just plug in the information over there. Okay, venture capital firms. So venture capital firms typically invest in high growth potential startups, right? They invest in startups that are typically beyond the seed level. So some revenue, they have some traction, they have some proven business model already. That's typically where venture capital firms come in. They invest in early to mid-stage startups. They invest in equity. And they typically will hold until acquisition or IPO, or they may even exit perhaps during another funding round. So let's say if they invest during a Series A, they might exit during a Series B or Series C or so on. Venture capital firms also sometimes buy the shares of angel investors. So let's say if you invest in the angel round of a startup, one exit for you as an angel investor could also be you sell your shares to a VC during the Series A or Series B. Okay, so the largest element I would say in the funding ecosystem is private equity. So private equity makes up, private equity funds. They can be sovereign wealth funds. They can be pension funds. They can be, very, very large companies like BlackRock. These are private equity funds. They invest in companies, larger companies, and growth stage startups. So growth stage startups, like Grab, Gojek, Spotify, companies like that. Some may argue that these are actually not startups anymore; they're MNCs. But I think you know what I mean. They make larger investments, typically 25 million and above. Generally, it would be a Series B, Series C, Series D, and so on. The average fund size of a private equity fund is about $5 billion, and they will typically hold until acquisition or IPO. So what does the startup fundraising rounds typically look like? There's your pre-seed, Series A, Series B, Series C, Series D. And the image on the right side illustrates basically what does this look like as a business grows, over the years. So the pre-seed startup typically is the highest risk in the journey of a startup. That's why angel investors who come in at that time, they enjoy the highest returns if the startup does well, in the future. And as you see that in the different funding rounds, the tree, the plant becomes bigger and bigger and bigger and bigger. And then at the later stages, private equity firms can come in and make very large investments into these startups. And they might get, 2x return, 5x return, but the risk is less and the returns on that size of money becomes very, very big. And as for angel investors who invest maybe 10,000, 20,000, they invest, they enjoy like a, 20x, 30x, 40x return if the startup makes it to that level. So who typically invests in all these different stages of startups? You have, your pre-seed level, you have angel investors and accelerators. In your seed level, you have angel investors, accelerators, family offices, and venture capital firms. In your Series A, there's venture capital firms, corporate venture funds, and family offices. Series B is also about the same. But when it comes to Series C and Series D, that's when private equity typically enters. And that could also include, sovereign wealth funds like, like Temasek Holdings, like the Sovereign Wealth Fund of Dubai, Norway, and countries like that. They do invest in startups quite a bit. So some of the top venture capital firms in Singapore last year are at the top of the list. We have 500 Global, which made, I think, close to 3,000 investments till date. And every VC fund has a sector focus. Some of them would be agnostic as well, but generally you'll have VC funds, they'll have a sector focus. So 500 Global will be technology. And I think that's a very broad, anything can be a technology company. If you were to look at something like Jungle Ventures, somewhere in the middle of the list, there's technology, there's healthcare. And if you were to look at Cocoon Capital at the bottom of the list, it's enterprise, deep tech. So some of them can be very specific. And it's good if you know, like, let's say before you approach a VC, it's good if you know which industry, what is their check size, what kind of investment round do they typically look at, so that you can target your approach to those VCs in a more smart and more productive way. Because sometimes I hear of startup founders that they'll just, send the same email, to like 100 different VCs. And yeah, it might not be the best way to approach it. Okay, syndicates, right? So when it comes to syndicates are typically like groups that come together. Like in Bangladesh, I think you have the Bangladesh Angel Network. In Singapore, you have Business Angel Network, Southeast Asia, you have Angel Central. These are basically where individuals pool their money together to invest in 1 or 2 or 3, whatever different startups. So let's say each startup would have a different business entity, right? So a group of 20 people, but the amount of money that we have in order to invest is not as much as the founder wants. So let's give the example, today we're here because of interactive care. So let's use interactive cares as an example. So let's say Samir Bhai is raising 200K. Says we take check size of minimum 50,000. Only have 10,000 each, to invest. So we can approach a syndicate like Bangladesh Angel Network, or we can form a special purpose vehicle where we can all put our 10,000 into that, to the amount of 200,000. Special purpose vehicle, which is a business entity, which will then invest in interactive cares. So this is generally like a private group. One individual has control. Like it basically has to go on consensus basis of the whole group. So talk a little bit about. So special purpose vehicles can be registered in Singapore, Dubai, Hong Kong, I think Delaware, and a couple of other places. Specifically to hold a specific time period. Syndicates, let's say you could invest in a Series A and you can exit in a Series B. SPV will be dissolved after that, and all the investors will be paid their principal and earnings after that. So there's a profit in that investment. Next up is venture building. So I'm fortunate that I had the opportunity to work in venture building for a while. And I was part of the in-house venture building team at ING Bank. We were looking at different problem statements in the bank and how we could resolve those problems by building ventures on behalf of the bank. So this is done in a couple of different ways. So the way we did it was in-house, but there's also like many venture building studios where like studios will work together with corporations to identify what those pain points and problem statements are. And then you will have external people from those companies working to build ventures on those problems, to resolve those problems. So some of the examples in Singapore are, let's say, Boston Consulting Group, Future Labs, McKinsey, Rainmaking, Mark 49. And these are highly like focused on specific industries to resolve the pain points in those industries. So it could be like, let's say, food tech, it could be agriculture, it could be logistics, it could be shipping. There's typically a lot of venture building in these industries. And the Singapore government actually co-funds part of venture building activities. So for example, let's say you're a large company, for example, like, let's say, what could I say? Let's say you're a bank. For example, you're, DBS Bank in Singapore, and you contract a company like Boston Consulting Group to run a venture building program. The Singapore government will typically fund part of that initiative because they want to encourage venture building activities to take place. So the venture building process typically looks like this. There's the idea generation phase, there's the concept validation phase, there's the venture launch phase, and then there's the scale up phase. From experience, I can tell you it's actually it can be quite hard in a corporation to push through these different levels. Excuse me. The reason being that large corporations, their risk appetite is quite low. So they're sometimes, the risk appetite is low. So they have a lot of like layers, I would say, in order to pass before a venture can actually come into the market. Each of these levels, when you go from one to the other, there's like an internal pitch, and then various different stakeholders in an organization need to approve it before it can go to the next level. So I learned an incredible amount in the venture building space. About how corporations view innovation and ventures, and also a lot about design thinking as well. So they take a more, I would say, like a more academic approach to building ventures, whereas I was typically used to a more grassroots way of building ventures, where, typically in the startup ecosystem, you think about something today and you start doing it tomorrow, right? But in the corporate space, it's like there's maybe 5 or 6 different layers of approvals to go through before, before you can make something move. Okay, multipliers in the startup ecosystem. So these are like my favorite, I would say, right? There's accelerators, there's incubators, there's entrepreneur communities, there's angel investor groups, there's co-working spaces, there's innovation labs, and generally we'll know startup ecosystem as these actors, right, in the space. But it is bigger than this, right? There's venture building, there's private equity, there's sovereign wealth funds, there's universities, there's a lot of different parts of it. There's a lot of different elements that come into the startup ecosystem. Beyond this would be the first layer. Some of the well-known multipliers, and I use the term multipliers as a catch-all phrase, for all of these guys. Accelerating Asia, very, very famous. Antler, very, very popular. These two, I would say, are typically agnostic. I don't think they have an industry focus. 500 startups also agnostic. F10 focuses on fintech, I believe. Iterative, plug and play, I think. InsurTech, different segments. But yeah, these guys are all very active in Singapore, and they have a lot of events and stuff like that where you can go and watch their pitches and learn about the different startups that they work with. Pre-COVID, I used to attend a lot of events with these guys, and it's amazing how many people you can meet, when you do that. So yeah. Okay, cryptocurrencies. I know that today the cryptocurrency market is actually quite quiet. But I feel like this list wouldn't be complete without mentioning cryptocurrencies, because all said and done, they do make up an element in the startup ecosystem. And I don't know whether they're going to make it. I mean, I don't know whether they're going to make a comeback or whether they're eventually going to die out. But over the last, I would say, 5 to 10 years, there has been significant space for cryptocurrencies. Bitcoin, Ethereum, meme coins, exchanges, wallets, altcoins. There's been so much of activity, white papers, ICOs, launches, and all of this has been going within the startup ecosystem. So I don't think we can totally dismiss cryptocurrencies. I think they might be around for a while, but it's just how strong do we think that they're going to be in the startup ecosystem over the next 5 or 10 years. It's hard to say. Okay, so this is the second part of my segment where I'm going to be talking a little bit about how to pitch to angel investors and how to go about, speaking to angels. How do you go about finding them? What are the things that you should and shouldn't say? So if you're pitching to an angel investor, I would say when an investor says no, accept it, but always ask for feedback. And many times, and I've done this as well, right? As an angel investor, I feel a bit bad to say no to a startup, so sometimes I won't reply. And I feel like many times angel investors do that also to other startups where they simply don't reply. So if you sense that, let's say the investor that you're trying to get an investment from is perhaps ghosting you or they're not replying, you can simply send them a message and say, I understand that you might not be investing at this time. We would love to get some feedback from you. If you can share with us where we can improve, perhaps we can come back at a later date and we can speak again. Secondly, every coffee meeting or every call is an opportunity to ask for introductions. You might meet an investor who you feel like, okay, either you don't want their money, or perhaps you don't think that they're ready to invest in your startup. You could ask them to introduce you to perhaps some of their friends, some of their colleagues, and don't waste any opportunity for networking. Number 3, avoid giving away equity. And I can't stress this enough, right? Because I've seen horror stories, right, of startups where they give away 20%, 30% in a very early stage. And I'm like, guys, you need to go and get that back somehow if you want to go and raise funds in the future, because it's very hard for you to raise money later on if you've already given away a large chunk of your equity. Use as much as you can. So be giving away the equity. Safe note is, yeah, it's basically like, yeah, it doesn't show up as equity until it converts later on. So identify strategic advisors and advisory board members. This is really important because let's say, for example, if you're a founder and you've been in a particular industry, let's say for 5 years, 10 years, it's safe to assume that your network is probably in that space, right? But let's say when you work with advisory board members, they're going to be opening doors for you strategically. Be making introductions for you, and they're going to be making help you get partnerships, help you get investors and things like that. Do keep in mind that you also need to incentivize advisors as well. And I would say try to keep it let's say within 2 to 3% or lower if you can. Anything even close to 10% is like in a co-founder territory. So try to stay away from going that high. And when you work with advisors, on a vested basis. So don't give the equity up front. Have it on a 1 year vesting, 2 year vesting, 3 year vesting, or whatever you both agree upon. Personally, I've done advisor agreements where I've taken 0.6% over 1 year. And I've done advisory agreements where I've done 5% over 3 years also. So it really depends, but try to keep it at a minimal as much as you can. Don't ask investors to sign an NDA because they'll probably ghost you. I feel like the secret sauce is not in your pitch deck. The secret sauce is in your execution, right? I could take your pitch deck, but I couldn't replicate your business. I wouldn't be able to. I don't have the knowledge that you have, right? So NDAs are something that I'm typically not so fond of. I think most investors also are not so fond of that. So something to think about. And co-founders, when you're pitching together to an investor, try not to interrupt each other. Try not to make sure that you keep it very polite and very calm and very cool, and be confident but not arrogant. Yeah. So when it comes to identifying angel investors, have a one-liner, right? So that you can convey what you want to communicate to the investor easily and quickly without going super long and without going on and on and on, so that the investor also doesn't get bored. Let's say you meet somebody in a party or in a startup event or a conference or something. Something very simple. Hi, I'm Mustafa. I'm the founder of X. We're looking to help startups get the right tools and hacks so they can fundraise faster from the best investors fast. Very clean, very simple, conveys the message in 20 seconds. What's your ask? Well, we're raising 250K at a valuation of 3 million, and I'd be happy to share more if you like. You put these two together, and then you have your elevator pitch, which sounds something like, hi, I'm Mustafa. I'm the founder of X, and we're looking to solve for the gap in early stage startup funding by equipping founders with the right knowledge and hacks to fundraise faster. We're looking to raise 250K from strategic angels, and I'd be really happy to share more if you like. So this is simple. It gets the message across. And you also know as a founder that do you want to spend more time speaking to this person because you already get a signal from them that they're interested to know more or not. Okay. So typically angel investors, you'll find a lot of them hanging out in places like incubators, accelerators, co-working spaces, innovation labs, events, conferences. You can do cold outreach. I think the response for that is a bit low, but I'll give you some tips on that in the next slide. Syndicates. The only thing is that when you approach angel investors in these environments, the thing is that they're generally bombarded with a lot of deals. So to approach angel investors who are mentors in accelerators, yeah, they'll know the startup space very well. They'll know exactly how angel investing works, but they have a lot of deals to choose from. So then that's up to you then how you present yourself and your business in a very unique way to get their attention, because there's a lot of startups out there, but there's a finite number of angel investors. So How do you stand out of the crowd, you know? So if you do a simple LinkedIn search, right, you would find, if you search for, like, let's say, angel investor, mentor, board advisor, venture partner, limited partner, I can think of a couple of people already in my circle who show up simply when if you put in these keywords. When you connect with people on LinkedIn, connect with potential angel investors, ask for advice. Don't ask for money immediately. Because I can tell you that I get, like, me and other people also that I know, we get a lot of people that add us on LinkedIn. And then the first thing that happens is you get like a really long message with a pitch deck attached. And I mean, you don't even know if the person has the interest in knowing about that startup, if they're an investor in this space, are they deploying capital currently? So I would say exchange a few casual messages first. It takes a bit more time, it takes a bit more effort, but trust me, the personal touch goes a really, really long way. The startup that I invested in Pakistan, Pattern, it was exactly like this. The guy messaged me and said, "Hi, Mustafa. I see that you've been in the startup space for a while. I would really love to get your feedback." We had a call and we totally hit it off. We got along really well. I really liked what they were doing. And it wasn't an investor conversation. It was just I just wanted to learn from them. They wanted to learn from me. And I ended up becoming an angel investor with them. So think about this paragraph right here. "Hi, Mustafa. Great to connect. I noticed from your profile that you've been in the startup ecosystem for over a decade. I'd love to get your feedback on my pitch and business model. Can I buy you a coffee sometime or connect over a call?" Trust me, this is an instant yes. Plug in some information from that person's profile. Like, I saw that you've been in a bank for 5 years. I saw that you've been in semiconductors for so many years, whatever the scenario might be. So this shows that you did a bit of research about the person. You admire their journey. You wanted to get some feedback and advice from them. And once you have a little bit of a rapport with them, right? You have a bit of a relationship with them. Ask them if they'd be keen to invest in your startup. Ask them if they'd be willing to introduce you to people, right? Because through reference also increases your chances of getting an investor rather than cold outreach. Okay, some pitch deck best practices. I'm not sure if you guys have heard of the 10-20-30 rule. I think this was created by a guy named Guy Kawasaki or Guy something. I think Guy Kawasaki. So basically the 10-20-30 rule means slides. I think you can go up to 15. That's okay in my opinion. 20 minutes to present. It's no smaller than 30. It's a presentation. It's not a document. And I saw this happening a lot when I was in management consulting and in KPMG. I saw that there were so much of stuff on their presentation decks. And I was like, guys, what are you doing? Are you building is this like a document or a report, or is this like a presentation, right? So ideally you want the viewer to be listening to you while you're speaking and not trying to read the words that are written on your slide deck, because you want their attention on listening to you and not trying to be reading all the words on the slides. So sometimes we think that the more information we put, the better, but sometimes I would say less is more sometimes. If you can communicate it verbally, that's the best way. If you are an angel investor, these are some of the things which the hard way, right, over the years, is really important, right? Like how willing are they to learn? How coachable are they? Are they willing to take advice? Are they willing to pivot when necessary? Do they take a data-driven approach, right? So, meaning like you have to go where the numbers are telling you. You can be passionate about a particular subject, but let's say if it's not making money, then you have to understand that somewhere else, right? And it takes a lot of maturity. It takes a lot of discipline to be able to understand that, right? So does the founder take a data-driven approach? Do they pivot and change their business accordingly in order to make money for the shareholders? Registration domicile. Also very important. Like I see incredible businesses in places like India, Bangladesh, Sri Lanka, Indonesia, Myanmar, Philippines. When it comes to like attracting international investors, right? You want the business to be registered investor friendly. So typically, Singapore, Delaware, yes to Singapore. So if you ask me any day, I'll say Singapore because I'm based over here. It really increases the chances of getting from overseas angels and VCs. In places like Singapore are very, very investor friendly. So when it comes to like capital gains tax, when it comes to inward, outward remittance of money, it's very, very simple, very, very clean, and very fast. The next one is valuation cap. So let's say you're investing in a startup, or let's say even as a founder, right? Think about what's the valuation cap that you're setting on your startup when you go out looking for money. I would say a decent starting point is somewhere between 2 to 5 million, depending on what you're doing exactly. If your starting valuation cap is 10 million, 20 million, I wouldn't say it's impossible, but I would say that there has to be something really, really special and really, really, really unique in order to justify that valuation, which brings me to valuation matrix. So like, as a founder, what is the logic or what is the mechanism that you're using to come to a certain valuation? Is it the market size? Is it the addressable market? Is it how much customers spend on this particular product every day, every month, every year? And I know that finding these data points can be difficult, right? But it takes a bit of research, and if you can justify it, then you're in a much better place. Valuation journey. So valuation journey is like quite, I would say it's a projection, right? But as an investor, I would want to know from the founder that what is the valuation journey that you see for this startup? And it's hard to, like, I can't hold the founder accountable for this because it depends on market forces and many things, right? But if the founder has an idea that they can convey that, okay, today we're worth 5 million, but let's say in the next 1 year, we hope to raise at 10 million. In the next 3 years, we hope to raise at 30 million, 50 million. And we want to reach these milestones along the way. We want to increase our team size by, let's say, 2x. We want to increase our customer base by, let's say, another 1,000 customers and stuff like that. So these are things that an investor would want to hear. Market size, you would want the founder to know about what the market size is, how big is the addressable market, and so on. Exit opportunities. So it's good to have an idea of where the investor will have their exit. So let's say you're communicating to your investors that how long do you think will the turnaround of their investment be? So you can tell them that perhaps there will be an opportunity for them to exit when a Series A investor comes or when a Series B investor comes, or let's say perhaps in an acquisition, or perhaps in an IPO. An IPO is a very, very long journey. I don't know. I feel like most angel investors wouldn't stay for that long a journey, but yeah. Here are lessons I've learned over the years, and this is bringing me to the end of the talk already, but this is some things that I wanted to share that I've learned over the years. It's okay to walk away from a deal. Sometimes the gut feeling isn't there. Sometimes you're just not convinced. You may not be convinced. If you're a founder, you may come across an investor that has a lot of money, but perhaps you don't like their personality. Perhaps you just have a gut feel that you don't want this person to be calling you and nagging you all the time. So it's okay to walk away from a deal. I've done it before, and we feel afraid, right? That like, if I walk away from an opportunity, perhaps I won't get one after this, but it's not true. There will be opportunities. Go with your gut feel. Every coffee meeting counts. Build a strong network. So a network is really, really, really important. I can't stress that enough. So take every opportunity you can to meet people, to connect with people, build meaningful relationships so that you can call on people to say that, okay, hi, Mustafa, I need your help for something. Have a quick personal pitch, to introduce yourself, like, hi, my name is Mustafa. I've been in the startup space for, more than 10 years. I've worked with KPMG, ING, and the Singapore government, and I'm an angel investor, and something very quick like that, like 20, 30 seconds, so that you can convey your profile very quickly. Be flexible about how. So this is something that I feel like as we get older, we learn this the hard way, right? We have a lot of goals in mind, and as we achieve those goals slowly, we learn that it's not always the way we want it to be, right? It can happen in many, many different ways. So stick to your goals, but be flexible about how you might achieve them. Keep an open mind, because the journey may change. Salary is not everything, and don't be afraid. I can't stress that enough. Don't be afraid. I'll give you an example about fear, right? Like, when I first started in my career, public speaking was something that I was really afraid to do. And I remember when I first joined the public sector, I had to give a presentation to like 20, 25 business owners in a conference room. There's a long table. I was standing at one end of the room with, a big screen with slides, and I was giving a half an hour presentation. And I was like shaking, my hands were shaking, and I was sweating, and I was just really scared. I got through that. At the other end of it, after that was over, I felt so much better, felt so much more comfortable. I was like, thank God that's done. Even the coffee tasted better. But then slowly, as I did more presentations, slowly 25 people, 50 people, 100 people. Eventually, I hosted an event for 1,000 people even. And at that point, I realized that through practice, I became desensitized to the fear. I was no longer afraid of it. And I actually started to quite enjoy it. So if there's something that you're afraid of today, it doesn't have to be like that always, right? So don't be afraid, keep an open mind, and I wish you guys all the very, very best. I've actually come to the end of my slides, and I'm really happy to take any questions that you might have. I'm really grateful for the opportunity to speak to all of you. And yeah, I see that there's some messages in the chat. Samir bhai, do you want to let me know if you guys have any questions, or if you want to unmute yourself and ask any questions? Before I stop, I just want to also say that I have a product called the Masterclass on Fundraising in Singapore, which is available in Bangladesh through Interactive Cares. It's priced at about, we've kept the price very, very low. In Bangladesh, it's 1,000 BDT. And if you're buying it internationally, it's through my Gumroad page, it's $10 USD for the next couple of days. So, and feel free to connect with me on LinkedIn as well. I'd be really happy to interact. And Samir bhai, I'm happy to like take any questions from anyone. And yeah, that's it for me.
Yes, thank you, Bhai, for the nice session. I guess there are some questions in the masses. So if I take one of the questions, like how much of our idea do we need to reveal in the pitch deck, and how many slides is standard for a pitch deck? And the question is asked by Mr. Tanvir Morshed. So yeah, over to you.
The question, I would say try not to make your pitch deck too long. So like maybe like 10, 12, 15 is just nice, not longer than that. And how much of your idea do you need to reveal? Most investors will want to know like everything about your business. They'll have at least a few interactions with you, and they'll ask you a lot of questions. Generally, I would say, and don't be afraid of revealing your idea to the investor, because like I was saying earlier, right? The investor, your pitch deck is not the secret sauce. The secret sauce is your experience and your execution of the business. Excuse me. So don't be afraid to like talk about what the business model is and stuff like that. yeah, you will have to reveal actually what the business is. So yeah.
Yeah, so we have another question by Abrar. He's asking that what's the process of finding investors?
What's the process of finding? Okay, so I would say, like, first of all, like, have all of your materials ready, right? Have your pitch deck ready, make sure that, you know, you're able to communicate it well and clearly. After that, go out looking for investors, connect with investors on LinkedIn, ask them for calls, ask them for coffee meetings. Once you have, let's say, have an idea of how much money you need in order to execute that particular phase one of your business that you want to do. So let's say I need to raise, you know, 100,000, the first pre-seed round, right? I'm looking for angel investors, perhaps to 400,000. So I create a pitch deck and I talk to angel investors, and I break down in the pitch deck what exactly am I going to do with this 100,000? What am I going to use it for? What is the milestones that I want to achieve? And then I start speaking to angel investors, right? I start to show them what my business plan is, what my idea is, and yeah, then hopefully you'll have a business registration also by then, either in Bangladesh or in Singapore or any part of the world, where then you can facilitate that particular transaction through that business entity. Yeah, and yeah, I hope I answered your question properly.
Okay, thanks, Mustafa bhai. So another nice question is by Mr. Tanvir Fahad Haq. He is basically asking about the strategy of raising fund for incubators in Bangladesh, and he also wants to connect with you, and he shared his LinkedIn ID in the message option as well.
Sure, thank you so much. Happy to connect. Let's say if you're starting an incubator in Bangladesh, I would say that, like, it would be good to explore, like, investors on two fronts. One would be, let's say, incubators in other parts of the world, to see if they would want to partner with you to run a program in Bangladesh. So, like, you know, organizations like Exciting Asia, F10, and then there's so many of them out there, plug and play. One would be to, like, let's say, run a partnership program in Bangladesh. Another way would be to explore with industrialists in Bangladesh and corporations in Bangladesh, you know, like manufacturing companies, hospitality companies, insurance companies, software companies, to see if they'd be willing to ask them perhaps what are their problem statements that you can help run an incubator program for them to help solve some of their problem statements. In a way, you'll be running your own incubator program, but you'll also be helping them in a way, and they'll be funding you to help them. So something to think about.
Okay, thanks, Mustafa bhai. Another interesting question by Mr. Wasiul Haq Choudhury. He basically asked about the exit opportunities for the investors investing in Bangladesh, since IPO is not a viable option as the stock market is not that proficient.
Yeah. So in this case, right, it's better if you have the offshore business, right? Dubai, Singapore, or something like that, because a larger investor can buy your shares from overseas, right? They can buy the shares that are in the other country. And typically the transaction doesn't need to be in Bangladesh then. It will be entirely outside. IPO also can be in Singapore, can be in Hong Kong, can be in America. Yeah, so the exits that I've seen typically have happened outside of these countries in South Asia, which makes it a lot easier, I would say. Yeah.
Okay, we have a really interesting question, and the debate is going on for decades. Which should be prioritized, profit or growth?
Oh, that's a good one. It depends on the business. Yeah, it depends on the business. Like, there's a lot of businesses out there that there's a lot of startups, you know, that never make any profit, but they grow so big and the valuation becomes in billions, and the founders make a ton of money, but the business never made a profit. So if you ask me, my opinion is profit. yeah, make a profit that's more sustainable. Because if you're aiming for only growth, you'll need to keep raising money again and again and again to survive. And you don't want to be in that position. So my opinion is profit versus growth. Yeah, profit. You would want to profit.
Okay, so how to divide equities in a fresh brand new startup scenario is like that: a founder, a co-founder, an employee, keeping some for future investors, reserve pool for the company maybe.
Okay, so like let's say there's one or two founders, they will probably hold majority of the shares, probably something like 80% will be held between the founders. Then perhaps you have like maybe 10% for employee stock options, or maybe even less, maybe about 8% for employee stock options for long term. Then you have another 10-12% where you start to release that slowly, like as you fundraise, right? Just ensure that the founders retain as much of the equity as you can in the long run, because that's a very, very important thing. I would say that there's no fixed formula, right? That what is it supposed to look like? There's no fixed formula as to how much you should give for early employees, or how much you should give your CTO, or how much you should give your how much should the founder hold. But I would say majority should be held by the founder or co-founders. That's the most important thing. And try not to give away a large portion of equity in the early stage of the business. I hear stories about like founders will tell me we really needed to raise funding badly, and that's why we gave away 10% or 20%. Please don't do that. Yeah.
Okay, thanks. Another question by Mr. Saidul Ashraf. He asked if the process applicable for growing SME as well, or we have to convert as a startup model to attract the VCs, being a SME.
Okay, so SMEs, the way they value businesses and stuff is a bit different, right? Like, they will value it typically on the business's assets, the cash flow, it typically looks a bit different, right? It depends. What industry is this SME in?
I would request Mr. Saidul Ashraf, if he is present, to share his idea.
Yeah, like what industry is the SME in?
Hello.
Hi.
Hello. My question was that how this process is applicable for the SME. So if SME found that farming, non-perishable business,
Yeah.
like that. So is this applicable for the VC procedure, or I have to convert it to the next one, like startup?
Okay.
Or
Okay. Thank you, Saidul. Okay, for SME businesses, right? Typically, how the investment typically works in SME businesses is that an investor will normally buy the shares of that business directly, right? And they will enjoy the profit or like the dividend of that business. So the structure of it looks very different from that of a startup. So yeah, I would say that if you wanted to go on this journey as building a startup and raising money, from investors and things like that, in this kind of a route, it is fairly different from the SME way. So how can you convert it? I haven't seen that done before, right? So you got me thinking about it now. If it's in like, let's say, farming or agriculture or commodities and things like that, I would say that the startup route is probably not so suitable unless you're doing something tech enabled, like you're enabling the farmers in some way through some app or or you're helping get those goods to market through some online marketplace, like that, then yeah, the startup route is feasible for you. But if it's a normal SME business, then probably not.
Okay, I understand. So in that case, I have to build a mother company. So that will be tech venture, could be a tech venture. Then my SME could be a sister concern of that company. And
Yeah,
if I want to divide it the share, so I have to divide it from that mother company, right?
yeah, that's possible. I think that's definitely possible. I would love to like engage with you and like hear more about it, and then hopefully I can guide you the right way to do it. Then,
Thank you.
welcome.
We have a couple of questions more. Mr. Wasam, he asked if an angel invests 0.30 million and later on, if any VC give 1 million, then what value can any angel get as exit? Industry is circular economy.
Somebody's put 0.3 million and then somebody puts 1 million. What kind of exit can they get? So it depends on like different factors, right? Like what round was the 0.3 million? What round was the 1 million? What is the business profitable? Typically, if it's in the same round, then there won't be any change in the valuation, I would say. But if it's a later round, then the first investor, their valuation obviously will change. Yeah.
Another question is how to set the right valuation for a quick idea startup.
Yeah, a good starting point I would say is like, let's say like around 2 million. Yeah, 2 million or so is a good starting point, I would say. Yeah. And then let's say if you feel that, it's very unique and, I've seen early stage going to like 3 million, 3.5, rare cases even up to like 5 million, but I would say the 2 million range is a good place to start.
Thank you, Mustafa bhai. I think we are done with all the questions, and it was a really nice show. So if you have anything to say.
Thank you so much. I really appreciate the opportunity to like speak with all of you today. Please connect with me on LinkedIn. Please check out my masterclass. The links are, in fact, let me just put it. Let me put it in the chat box if I can, so that you can get the chance to check it out. And give me just a moment. Yeah, please connect with me on LinkedIn so that we can continue to engage. And yeah, Ramadan Kareem to all of you, and have a very, very lovely evening ahead. And I wish you guys a blessed fasting month ahead. And let's connect, let's stay in touch. Samir bhai, thank you so much for facilitating, and have a wonderful night ahead.
Thank you, Bhai, for your time. It was a great session. We learned a lot, and we are looking forward to have you more in this kind of sessions. Yeah.
I hope to visit Bangladesh very soon.
Yeah. Welcome to Bangladesh, and I guarantee you will feel great after visiting Bangladesh.
Inshallah.
Thank you so much.
Thank you so much. Good night, everybody. Assalamu alaikum.
Assalamu alaikum. From Iqbal, Dhaka, Bangladesh.
আপনারা কি চান খালি আমাদের দিন বেলা ধরে একদম মারুক আর বুকুক এটাই তো চান মনে হয় তাই না আপনারা কি এটাই মনে হয় অনেক এটাই আশা করেন নাকি যে
I take it the session is over now for today. Everyone, wish you all the best and have a good one.
Thank you so much.
But